Hey everyone, it is Thursday, March 9th, about noon on the West Coast, and it's time for another market update. Since I last left you guys, Friday went pretty well for the markets. Monday was really quiet, pretty flat. Starting Tuesday, though, you might have seen this on the news, Fed Chair Powell started addressing Congress. So Tuesday, he spoke to the House. Wednesday, he spoke to the Senate, and he basically just repeated things we've already heard over and over again, like inflation needs to get under control. There's more risk in underdoing it than overdoing it with rate hikes and so forth. Markets still did not like it, so they reacted negatively. But the one thing I wanted to touch upon, there's a metaphor from the Nobel laureate Milton Friedman that has to do with Federal Reserves and economies. It's called the fool in the shower. So basically, the fool gets in the shower and turns on the water, and the water's really cold. So that's the equivalent of when interest rates were really low, and inflation got out of control. So the fool then thinks, I need to turn the water hotter. So they turn it up a little bit. And we know that water takes a long time to, sometimes water heaters take a while to warm up. So you don't see immediate effect. And that would be the equivalent of the rate hikes they've done previously. So these rate hikes that they make, they don't automatically just all of a sudden the economies change. It takes a while, months at a time, or months for these changes to take effect. So that would be the fool turning on the water a little bit hotter, not seeing anything. And at that point, they think, hey, I need to turn this up as hot as it goes. And we know what happens then. They burn themselves. And so that's what we have to worry about with the Fed, is that they're showing some signs that they're going to get more aggressive again with rate hikes. And if the current rate hikes they've done haven't even taken effect yet, then they risk burning us all. They risk scalding the economy and with hot water and putting us in a bad position. So that's something we have to keep an eye on. Next thing we got this week, we got a lot of jobs reports. ADP, JOLTS, and initial job claims. Take a closer look at this. So job claims, which is unemployment claims, this is actually set off a nice little rally today. These have been trending down. This week, they were expected at 195,000 new claims. They came in at 211. So don't want to see people losing their jobs, but the Fed's made it clear until we see some jobs weakness, they're not going to back off. So this has actually started a little rally. And the other thing they point out with the jobless claims, continuing claims are up to 1.72 million, highest in 14 months. So it seems like people are having a harder time finding a job once they do lose their job. The ADP, which is private payroll, non-farm numbers came out. There was 242,000 jobs created in February. This is seasonally adjusted, though. You take the seasonal adjustments out, it only showed 166,000. The Challenger job report, which only looks at job cuts instead of like job ads and then a net, that came in at 78,000 cuts, the highest since February, highest February reading since 2009. And then the cuts actually occurred in all 10 industries, all 30 industries that they track, which is the first time that's happened in 10 years. And then the JOLTS report. The JOLTS came in, openings were down. So they came down from last month, higher than expected, but the steepest decline since August. It's a 1.2 million job openings below the highest peak. So we've seen some weakness there. And leisure and hospitality is down 194,000. And really that's good to see because the ADP, the biggest gains they got was from leisure and hospitality. But just keep in mind, when COVID happened, about 10 million jobs were lost in leisure and hospitality. And ever since then, with the recovery, they've been adding back jobs. And if you look at the graphs, you look at the numbers, they're almost back at those pre-COVID levels. So, the ADP, we should stop seeing that big increase from the hospitality and leisure. And then in the JOLT, we've seen the job openings come down. So we should start to see that level off. And then real quick, I wanted to show you guys this as far as job openings go. So JOLTS is the black one. And this has stayed a little more elevated compared to all these private companies. Linked Up is LinkedIn's version, or, one thing that they used. And so, the JOLTS is looking at a 21,000 sample payroll, whereas all these, LinkedIn's got 200 million members. Recruiter, Indeed, they're looking at a lot bigger numbers than JOLTS is. And, so these numbers are a lot weaker than JOLTS has been. So the private companies are showing the job market is weaker than these national, the JOLTS, the Department of Labor basically reports. And then construction job openings are dropping too. So this is a big one too. So again, showing weakness in the housing market. Purchase apps were actually up this week, 6.6% week over week, down 42% year over year. That's, showing buyer resilience. So basically, even though rates were up, buyers are still out there looking. Probably going to be a slower spring season than before with lack of inventory and higher rates, but there's still people looking out there to buy, which is good for all of us. So where does that leave us? The average 30-year rate is down to 7.0 from 7.1. I actually think it's a little lower than that. That comes out a little bit early in the morning. Like I said, we're having a pretty good day, but still a lot higher than we want to be. We want to be down in those 6 numbers. We're in those, high sevens, high sixes, low sevens right now. So we got to keep an eye on that. I hope we keep the downward momentum. So important dates coming up. We got BLS jobs report tomorrow. That's a huge one, market mover. This is the one that started on February 2nd, started the downward or upward trend in rates, downward in the markets. So that's a huge one. We're hopeful. The data suggests this might be good for us. If not this one, the next couple ones, we're like we were just looking at those other job numbers. They're starting to show some weakness in the job market. We see weakness in the job market. The Fed will back off. That will be good for mortgage rates. And then we get CPI data on Tuesday of next week. And we're hopeful for that one too. Like we've talked about before, shelter costs are lagging. We're hopeful this is the report we start to see that catch up. And once it does catch up, that's about a 2% difference in the core inflation rate. That'll be a huge difference in the way the Fed's looking at this stuff and where mortgage rates would be at. And then one other thing I want to point out, March 22nd coming up here, we have the next Fed meeting where they're going to do their hike. And previous to this, they were saying 25 bips is what all the markets were thinking. Since Fed Chair Powell spoke on this week, it's flipped to 50. So, that's not good to see. We want to only go up 25, not 50. He brought that in when he testified in front of Congress. The market shifted. Now they're thinking that's what will happen. But like we said before, then we have the BLS job report and CPI and PPI. So if those go in our favor, fingers crossed, hopefully, they only do the 25 bip increase. So that's all I got for you guys today as far as data. Everybody, like I said, there's windows of opportunity in every market, and there's definitely an in now. If you have buyers that can afford where rates are, like we've talked about before, there's opportunities. You can get the house you want, get in front of it, not have to worry about multiple bids, get some seller credits, things like that, and get it before it turns up again. So if anybody needs anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Have a great day, everybody.